presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak Asset Management YouTube update for December 10th, 2021. Don't forget to subscribe to this YouTube update so whenever I post one, you'll get notified as soon as it is available. I'm Mo Ansari, President of Compak Asset Management. You can get the daily broadcast that I do every single day, the 1-hour update with great guests and what I'm thinking on a daily basis. Simply go to the Apple Store and download Market Wrap with Mo Ansari, or just go to our website, marketwrapwithmo.com, and you can download the free app so you can get the daily update that I do, the daily radio broadcast, a 1-hour broadcast. Looking at the December, we'll have a December meeting, an update, an exclusive. You can get on that, you can schedule, you can come back and sit down with us. If you've gone through the whole year and haven't gone anywhere, you bought this and you bought that, and then when you add it all up, it's gone nowhere, give us a call. We'll be more than happy to help. Develop a specific plan for you and get you a roadmap, get you pointed in the right direction. So 2022 is a great year. 2021 has been fabulous. S&P is up 25.5%, nearly 25.5%. And if you're anywhere in the market, you're smiling all the way to your account, as it's called. Let's start with the COVID, the Omni gone. That's what it is instead of Omicron? Well, everybody was worried about this. You heard me about it 2 weeks ago. I thought it was going to be transitory. It's like the horror movie. You know, the first time the bad guy jumps out with a knife, everybody jumps and it's scared. The third time it happens, it's not as scary, and the 12th time, it's just boring. And that's really what we've become. It's the 12th time, 12 variant that we have had. We are vaccinated, we are protected, and yes, we are going to have these variants coming from time to time, but we have gotten so used to it. As I said, I didn't think there were going to be any lockdowns. We don't have any. And what we're studying right now and finding out, it's much more transmissible, but not as virulent. So what that means is that, yes, people can get it, but when you get it, it's like the flu, it's like the cold. That's basically what it is. And as we get more and more therapy, more and more medicines out there where we can take a pill, if you do get COVID and you catch COVID, you get mild symptoms and then you can take the pill, you're fine. It's like catching the flu. You just got to be careful. That's where we are. Looking at the numbers, how immune am I, or boost or bust? That's really the question. The more shots you have, as Pfizer said this week, if you've had 2 shots, it's not as good. If you've had the booster shot, the vaccines are holding up against the Omicron. So I think Omicron is something that we'll have to learn with, just like COVID. A year ago, I said it's going to be an endemic, not a pandemic, and that's what it is, something that we'll have to learn to live with. Looking at the numbers, the daily reported cases, positive cases of 2019, have gone up of COVID-19. They're back up to the highs, but if you look at the positives moving forward, nowhere close to the highs what we saw with Delta, and daily deaths are not. They just did pop up a little bit, but now they're starting to come back down again. So that is the good news. It's not as virulent, and I think Omicron is something that's there. We should all be cognizant of it, should be careful of it, but it's not going to make any changes. Looking at all of these numbers, jobless claims, they're down 22.7% from the highs pre-COVID. So now we have less unemployment, or people applying for unemployment, than there were prior to COVID. Looking at the jobless claims, still about 16% higher. We're looking at weekly sales numbers. They're higher than where they were pre-COVID. Box office, we've gotten so used to Netflix and Amazon Video and all of that it'll take time for us to get used to going out to the movies again. That'll slowly come back. Rail car traffic is higher. We are back up to about steel production is about the same. Hotel occupancy is only down 10%. We might see a dip in the next few weeks because Omicron. These are numbers going back, I think, to 2021 December, beginning of December is where these numbers come from, December 8th. So they're about a few days old. Looking at the numbers, I think we are going to come back on hotel occupancies, might fall off a little bit. Dining out might be a little bit. There was, I saw some some surveys out there that about a third of the people are looking to cancel their trips for December. So we will see. Global flights are still under, but we are coming back up slowly but surely. The economy is roaring ahead. It's a problem for the Fed, and I'll talk about that because we did get inflation numbers today, and they neared 40-year highs. That's where we are. It's up. It came in at 6.8%, but the market went to new all-time highs today. Wonderful all-time high closing for the S&P. Inflation is up, but I think we might be getting to peak inflation. Yes, peak inflation, just like remember we saw peak oil and stuff like that. It might be peak inflation. That means because a big portion of inflation was energy prices. Energy prices are down 20%. Other things that we're seeing, we are unsnarling or untangling the supply chains. And that, as they get better, I think we're going to see more goods coming to market, more supply coming to market. And people, the bulge of money that was there, that was saved up because we just didn't spend it in 2020, has been spent now. If you look at the savings rate, that spiked up to 35%, they're down to 7.3%. So I think the bulk of that huge demand tsunami that we saw is gone. The supply is on its way. And when demand and supply starts to come in balance, it'll start to push prices down again. That is my feeling. That is my thought as far as inflation goes. But with the Fed, they might have to tap on the brake a little bit more. That's the expectation next week, that they are going to raise rates. They were talking about tapering at $15 billion a month. This is expected to go up to about $30 billion per month. That's what they are expecting to announce that on the 14th. They've got a FOMC meeting, Fed Open Market Committee meeting on the 14th and 15th. On the 15th, they're going to announce probably they're increasing the taper. That means they'll be done with the taper, or they'll be done pouring money into the economy, which they were doing at $120 billion before they start turning off the tap. Now they say they'll turn off the tap a little bit quicker, and they might be done with taper by March 30th, by the end of March. So that moves this July meeting up to March, where they could start raising rates. That's what the market is thinking now, that this moves to here and the rates start to go up in March or April. I don't think so. I think the Fed might announce that they're going to taper faster, but then they're going to say, well, we're going to wait and see how inflation does, how the economy does. People with higher prices might start buying less stuff, and that might bring demand down. So I think they might increase the taper, but also come up with a dovish statement. If they do that, like today we saw the inflation number at nearly a 40-year high, but the market went up instead of going down. We might see the same reaction. And then we'll find out if Santa Claus is still in town, or if Santa Claus has come and gone. If they keep the rates where they are, they make a dovish statement, even by increasing the taper. I think that could be positive for the market, and we could get to our targets that I've talked about. We are I'm going to do an update on all of this next month, where we're going to have a webinar where we're going to get into a lot more detail on the supply chain, and that supply chain is still snarled up. I mean, we do have supply chain problems, but they are starting to open up. Market right now, this is the Treasury, this is interest rates. We're still at the 200-day moving average. We had come down last week. We've come back up from there. I think rates will continue to go up. I still have a target of 1.79 to 1.85 for the 10-year Treasury. That's what I'm looking at right now. Are we going to get there immediately? Will it take us 2 or 3 or 6 months to get there? I think rates are going to continue to move higher. How much? Depends on how strong the economy is. S&P, new all-time closing high today. Finally, we went below last month's low, which was right here, and we went right below it and then turned right back up. If we can close above last month's high, that would be a monthly key reversal. That means we went below the previous month's low, closed above the previous month's high, and I'll show you the monthly chart at the end of the month, but that does not happen very often. So the target initially is 47.50 or so. That's the all-time high, 47.42, 43, right around there. If we can get above that, then I think we could get to that 4,800. 48.80 has been my target that I've talked about. That we could get there. How long could it take? Well, it depends on what the Fed says next week. the Fed comes out with a dovish statement, I would not be surprised that we get to 48.80 by the end of the year, the next couple of weeks. Looking at the long-term weekly target, this is a chart going back to 2018 or 2017 or so. If you look at this goes to 17, this is 2018, this starts at 2019, this is 2020, this is the COVID drop, and since COVID, we've come straight up. So this is wave 3. Right now, we're in wave 3, and that is the longest, strongest wave of the Elliott wave. This is wave 1, wave 2 down, wave 3 to the upside. Now, how high can we go on this? We can go all the way up. We need a fourth wave correction somewhere. I think we get that in the first quarter of next year, but the long-term target for 2022, 5,400 for the S&P. Yes, that's what I'm looking for. Depends where we close and what the Fed says, but I still think we're continuing to gain momentum. Because as interest rates go up, that is positive for stocks. Yes, people say, wait a minute, interest rates going up, how can they be? For most stocks, it's positive. Growth stocks, it might not be, but if you have a balanced portfolio, it's going to be okay. That's the way I'm looking at the market as the S&P. Somewhere we are going to get a fourth wave pullback, and then we start a fifth wave. But long-term target, maybe by the middle or end of next year, we could get there. NASDAQ, not as good, not at a new all-time high, which is around 16.2. Today, we did go up, just closed still below the 20-day moving average. But if you can get above 16.2, 16.750 becomes the target. But growth stocks, as interest rates go up, their growth is discounted. And that will take a toll on some of the growth stocks that might not do as well. Weekly chart again, we're looking at the 20-week moving average here. Long-term target, this is going to next year, about 20,000. I wouldn't be surprised to get there. It's going to be bumpy. It's going to be much more volatile next year. So now is the time for you to check your asset allocation and make sure you have the correct mix of assets. You have the correct amount of bonds to give you the right ballast so you don't tip over when the next small wave comes. So you have to be prepared for that. The gold market, still below the 200-day. I mean, inflation running at 40-year highs, gold should be exploding, but it's not. And when you get good news in the market and it does not go up, watch out for the downside. This is support around 1720 right here. That's 1720. If we break that, then this is the major critical support. Those are the lows of the triple bottom around 1670, 1670, 1665, 1670. If we break that, that would be very bearish for gold. But we close at 1780 today, 83, so we're still about $100 off that low. But if the Fed starts to really tighten, interest rates go up. When interest rates go up, the dollar goes up, and when the dollar goes up, that is negative for gold. So that's why we don't have gold in our portfolios. Crude oil, well, it managed to struggle back above the 200-day moving average, which is right around $70 a barrel. But, this looks like wave 1, 2 up, 3 down, and we're in the fourth wave. If we can hold 70, then I think we go higher, but it just depends. The talks are happening right now this week and next week in Vienna between the world powers and Iran. If there's some kind of deal made, the Iranian oil comes back on the market, then I think we could see lower prices. On the other hand, if Iran is not, we do not get the Iranians to back off, the sanctions are being tightened there. There are a couple of ships in the Arabian Sea that we intercepted and took off some of the Iranian oil that was going illegally to Yemen and some of the arms that were going there. So the Iranians know that the screws could be tightened even more. If that happens, we keep Iranian oil off the market, then going into the beginning of next year, we'll need the entire capacity, all the spare capacity of OPEC would be used up with all the demand coming in. Yes, our supplies are going up. Rigs went up by about 4 rigs more this week. We're about 471 rigs working now here in the United States. So our supply is coming up. But if there is any disruptions anywhere, that could really push oil prices sharply higher. That is something we have to watch in oil, what happens to the oil prices. Russell has been stuck between 2100, and that's this support line right here, and 2400, which is this line right here. So we've just gone back and forth, or 2350. That's what it should say, 2360 or so. And we've been stuck right here. We broke out above it beginning of next month, but then with what happened here? That's Omicron. This is I equate to the reopening trade. The Russell Small Cap Index is the reopening trade. We have to completely reopen for the small caps to come up. And we have come back up a little bit here, but we really need to get back above the 2360 area to clear the way for the Russell to continue moving higher. Those are my views. Those are my observations. Again, if you would like to have a free review of your portfolio, just go to Compak.com. I will spend an hour with you. We'll go over your portfolio. We'll give you a roadmap. We'll do a riskalyze. We'll show you a risk number. We'll show you a portfolio that matches that risk number. All of that is free. All you have to do is go to Compak.com, and we will be more than happy to sit down with you, or you can come into the office, or we can do it on Zoom. Those are my views. Those are my opinions as of December 10th. Have a wonderful, wonderful weekend. Look forward to talking to you soon.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.